Welcome to AHA Math and Science. In this video, we're going to discuss the compound return of S&P 500. So what is S&P 500? It is one of the really commonly used index. It's an index to track the stock performance of 500 larger companies listed on the stock exchanges in the United States. So here is a chart for the price of S&P 500 from 1928 to 2022. So over almost 100 years. So you can see that the upper trend of the index over the years is just kind of increasing. But in this upper trend, it also gets interrupted by a few so-called bear markets. So some of the recent ones is the burst of dot-com bubble in 2000, and also the 2008 financial crisis. You can see a very clear, drop of the index. And then the most recent one is a very brief bear market due to COVID-19 in 2020. So here you can also see that the 1987 Black Monday, so-called a fresh crash happened on a Monday in 1987. Just appears like a little bit, on the chart. And perhaps the horrendous sort of bear market during the Great Depression around the 1929 it's hardly visible on this chart. So it's very complex. You can see that it's not a straight line, although the index kind of goes more or less in uptrend, but it's very hard to figure out all these ups and downs, right? So in this video, we're gonna try to have really a close look at the underlying trend of S&P 500, right? And try to get a good sense of this very zigzaggy curve. So like most stocks, SP 500 index, it's also more or less can be described by the so-called compounding formula. A equal to A naught times 1 plus R to the T's power. And here, A naught is the amount of initial investment, and then the A is the current value of investment. And where R is some kind of rate of return, and T is the time. Now note that if the T can be measured in different units. If T is measured in days, then the R is going to be the daily rate of return. If the T is measured in years, then this R is going to be the annual rate of return. So the T and R has to be kind of correspond to each other. So if we take a log on both sides of this equation, what do we have? Well, we have log of A equal to log of this expression here. And the inside here, it's a product. It's A naught times 1 plus R to the T power. So the product log can be written as the sum of the logs of each individual component. So it just becomes log of A naught plus log of 1 plus R to the T's power. Furthermore, the log of a power function can be simplified by placing the exponent T in front of the log. So now we have this simplified expression here. Now this equation now becomes very interesting, because if you think about the log of A, which is the log of the investment, it's just the vertical axis, or we call the Y, and then the T is kind of our horizontal axis, kind of like our X. You can see that this really looks like a straight line. So if we plot the log of investment, we call the Y versus the time T, we should just expect a straight line, where the Y naught, which is kind of the intercept of the straight line with the vertical axis. And now the Y naught is related to the log of the initial investment. And the slope of this line is exactly described by this coefficient here, which is just log of 1 plus R. So this is what we expect. So instead of looking at an index or the stock price of an individual company on a linear scale, if we actually plot the S&P 500 over this almost like 100 years on a log scale for the price of S&P 500, we should really expect the index should follow more or less like a straight line. So let's see when we do that, what happens. And indeed, it looks like you can still see the zigzag, but it's more or less now looks like a straight line. So instead of this curve here, which is hard to see, you can indeed see that when the price of S&P 500 plot on log scale for the time, the in unit of days, you can see that the price of the index almost falls on this straight line, right? This straight line is kind of the trend, describing the trending of the price of this index. And in fact, this trend line can be described by this equation here. And so this is the intercept, and this is the slope. And this straight line actually models the data very well. And the R square, which is basically kind of like a measure of how good the model is, try to fit the data. So if R square is 1, it means the model fits the data perfectly. And here we get a R square is like 0.95, meaning that indeed the trend of this index kind of fluctuates, but more or less it can be described by this straight line to a very good level. And the slope here, as we discussed before, is just equal to log of 1 plus R, and it's just equal to 7.738 times 10 to the negative 5. And this R is actually the daily rate of return, because we are measuring the time in days as a unit. So we can now look at this equation and try to figure out what is the exact daily rate of return. So take this equation, and down we can get rid of the log. So the 1 plus R is just equal to 10 to the 7.738 times 10 to the negative 5. Remember, this is just the log at the base of 10. So we evaluate this expression, we get this value. And therefore, the daily rate of return is just equal to 1.000178 minus 1. That's the daily rate of return, which is equal to 0.000178, or it's just 0.0178%. It's a small value, but note that you get this daily rate of return that even on weekends and holidays when the stock market is actually closed, because this is just kind of shows you that on average, this is what you really get, for the return of an investment. So it's really kind of powerful. The number is very small. You don't really expect a huge daily rate of return, right? But the return kind of compounds day over day, month over month. So after a year, you can still accumulate a decent amount of return. So let's take a look at the annual rate of return for S&P 500. Start with the initial investment 100. So 1 year later, what will be the value of investment? So the formula, the compounding formula is A equal to A0 times 1 plus R to the nth power. Initial investment is 100. We just figure out the daily rate of return is 0.00178. And we're going to raise to the power 365. Why? Because you have 365 days. And remember that the daily rate of return works even when on weekends and holidays. So you just need to put in how many days per year. So this is what we get. So the value of investment is now 106.7 at the end of the year. So our annual rate of return is simply just take the final value minus initial value divided by 100. So it's 6.7%. And this is really kind of what you get. On average, you look at the history of S&P 500 over nearly like 100 years. And note that this return does not include the annual dividend yield of approximately like 1.5%. This number also kind of fluctuates, but this is on average what you get. Sometimes it could be 1.8, 2%. So what do we get? The total annual rate of return on average for S&P 500, and we analyze the data over 100 years, it's about 8.2%. That's not bad. So if you look at the rule of 72, which it says, the number of years it takes to double investment is just equal to 72 divided by the rate of return. Here we have like 8.2. It's approximately 9 years. So it just takes about 9 years. If you put all your money into SP and 500, every 9 years, you should expect your investment to double. Again, this is on average. So you get this average effect if you put the investment in the index for a long time. And sometimes, if you just over a period of 1 or 2 years, this does not necessarily work, right? It really depends on, the current, market. But on average, this is what what you should expect, right? So I hope you have enjoyed this video. And if you're interested, you can check out another related video on where I try to explain the rule of 72, and the link is below. So please do not forget to click the like button or subscribe to our channel so that you can watch more videos like this one. And thank you for watching.